Some of the biggest names in tech, like Apple, Tesla, and Amazon, are in correction territory, meaning they're more than 10% below recent highs. Optimism about the economic recovery and the reopening trade, combined with rising US Treasury yields, are luring investors away from big tech and towards other assets. So, is this an opportunity to buy some of the large cap US tech names for less? Or is this the start of something more challenging for the sector? With me to discuss is Serge Berger from thesteadytrader.com. Serge, great to have you back. Now, we seem to have got so used to these record highs for the tech sector, extremely lofty valuations. Now the Nasdaq 100 is in correction territory. What do you make of the sell-off that we've been seeing in some of these stocks? It's not really what we're used to.
Hey, Victoria, you and I have been talking about this for, I don't know, a couple of years now, that, there's the underlying volatility that begets volatility in these stocks, and then everything else goes down. The reality is when it comes to U.S. equities, particularly on an index level, they can't rise without tech rising. And the concentration risk has gotten so extreme on one side of the boat, on the crowding of some of the big names that we know, that mathematically the broader market just can't rise. So, we're down 10% in the Nasdaq 100. It's a function of rates, which we can touch on as well. But it's also a function of algorithms, and everyone just kind of taking the cue off the same sort of measurement. So, I think we're getting close to an opportunity where you can dip a toe again. Rates, in my opinion, are probably going to stabilize a bit here, and so, I'd pick my spots. I'd maybe wait for some stabilization a bit more, but I think we're getting to a point where we're dipping a toe in the water, and we've been doing this for the past day or so. It starts to make sense again. Much better reward to risk than we had just a few weeks ago.
Okay, so where do you stand in terms of the chart for the Nasdaq? What are you seeing? We're seeing futures rebound a bit today. Do you think that was the bottom, or do you think we could see some more selling to come?
I think the bottom is hard to say until we have some confirmation of that. But what we're looking at here is a simple chart of the Nasdaq 100, down 11 or so percent on a daily closing basis or so. We're back to what used to be resistance around $300 or thereabouts, depending on what tool you use. But this is the QQQ ETF. Again, I think we're about as clean a level we can bounce off of. Is it going to be a straight shot from higher? I don't know, but I would prefer to see another sort of bullish reversal day, meaning a day where we try to give some back and then close at the highs, or just a meaningful up day that gives us more confirmation that the lows of the past few days, which have now been tested about 3 times, that they are there and that there's seller exhaustion from a very near-term perspective.
Okay, so let's get into some of the individual names. We know that Tesla has been one stock that's been caught up heavily in this selling. It's pulled back by more than 35% or so. But when we put that into context of the recent rally over the last year, it's not really that significant, is it?
Well, Tesla's not back to where it was early December, actually mid-December. That's really not a big move. I think one of the things about Tesla to understand is the volatility. It's a very volatile stock. So it being down 35, 38% versus say the Nasdaq down 12 or the Nasdaq 100 down 12, that's roughly in line if you take volatility into consideration. You average, true range, all those kind of measurements. I suspect you're going to have buyers come in again. I'm looking for the same opportunity here where we're looking for some more stabilization, what we call follow-through buying or seller exhaustion from a pure trading perspective. But I think anywhere here in the low to mid 500s is fair game. Again, I'd see some more stabilization, but then I think you have an opportunity for a bounce. Now, ultimately, whether that bounce goes to lower highs, I think that's still out there, but I strongly suspect that it's going to be difficult for the stock to make fresh all-time highs anytime soon. So for me, this is more of a trade than a new investment in the company for the time being.
What about Apple? Because it had an incredible 2020, rallying by more than 80% across the year. But the iPhone maker seems to be heavily caught up in the selling as well. We're seeing a bit of a bounce back pre-market on Tuesday, but Monday saw a big decline of more than 4%. But surely this is a stock that's going to benefit from the reopening trade, the economic rebound as lockdown eases.
You would think so, and I think the underlying situation with Apple is still one of basket buying and basket selling. Again, it's such a huge part. It's still 6.5% or so of the S&P 500. I mean, it's one stock, right? And you take that into a basket. These stocks, a lot of them are being traded as a basket by institutions. So Apple goes down to correlation game. I think, from a purely technical perspective, if you want to look at this, I think, you're nearing a 200-day moving average here around, 114.15. I wouldn't be surprised if that becomes a fairly obvious level for the stock to find some better footing. Same story as with the QQQs or the Nasdaq 100 and the Tesla. I would look for some stabilization, for some further seller exhaustion and an actual up day, like of meaningful proportions, to really go in. But I think, again, we're down, whatever the stock is down. What do we say? Let's see, 20%. That's a fairly simple round number. If the stock gets to, even maybe 110, you have a spot you can kind of lean against, and I think the reward to risk is just a lot better now than it was just a few weeks ago. I think that's the overarching argument here. And from a seasonality perspective, March and April do tend to be good months, or at least the back half of March into April or so. So I wouldn't be surprised, particularly if rates come down a little bit, that we see another rally in these names.
Now, switching focus slightly, we've talked about some of the losers in terms of yesterday's session, but Disney actually was on the other side of the coin, outperforming the market amid optimism towards reopening of its Disneyland in California. That's expected on the 1st of April. Where do you stand on this stock?
First of all, I'm excited. I'm ready to go to Disney again. But I think we talked about this one last time. Disney's one of those stocks you could make an argument that is going to benefit both from the pandemic, which it has with Disney Plus, which I subscribe to for my kids, and
for your kids, sure.
And I watched The Mandalorian, but also you could argue it's a reopening play, right? As the parks reopen and other things, sports, there's Disney, ESPN, all those kinds of things. There's a lot of stuff going on there. It's kind of a win-win. And, is it going to get stretched here at some point? Probably, it's around $200. That's an easy level, purely technically, where you could say, okay, there may be some overhead resistance. I wouldn't be surprised if it has another, $10 or $20 of upside. It's, again, you could make either argument. And you have to think about, again, if you think about it in terms of basket selling and kind of thematic ideas that hedge funds and other institutions play, if the reopening trade continues to work, and I think it's got some more room, then I would think something like Disney is only going to stand to benefit from that.
Yeah, another stock like that is Uber. On the one hand, for lockdowns, it's got Uber Eats, and then when the economy reopens, of course, it's got its ride-hailing business. Now, moving on, you mentioned earlier about treasuries and inflation. We saw the 10-year treasury yield rise after the Senate package was the stimulus package was pushed through the Senate over the weekend. There has been a lot of discussion lately about the yield curve. I mean, how concerned should we be in reality about the rising risk of inflation because of, the economic rebound? And what would then be the knock-on implications for equities?
It's the billion-dollar question. I spent literally all weekend discussing this with fund managers and the likes. And I think in the near term, we could certainly see some overshooting in terms of inflation. And when I say near term, over the next few months. In the very short term, I wouldn't be surprised if rates have kind of hit about where they can. So on the 10-year, looking at about 1.6 and change % on the U.S. Treasury note. And if we ease off of here, then, as I said before, I think we could see a pretty good rally back into some of these mega cap tech and related names. To me, the bigger question is really what's beyond that. And, the very simple sort of question we're trying to wrestle with is, have we seen the end of the 40-year bull market? And, that question is epically important, because if we have, and again, this is something we're trying to grapple with right now, if we have, just about every portfolio model out there won't work. And I think this is just a bigger question. We can always come back on this at some point in the future, but that's the big question for me in the short term. I think rates are somewhat overbought, meaning that could lend support to some of the mega cap tech names. And later on this year, I wouldn't be surprised if we see a 2% 10-year just as inflation continues to push through and the reopening trade continues to work out.
All right, Serge, it's been great chatting to you as always. Thank you so much for sharing all of your insights.
Thank you.
And that was Serge Berger from thesteadytrader.com. I'm Victoria Scholar, and you can find more from me and the team on Twitter. We're at IGTV.